Welcome to the Deep Dive. Today, we're tackling a really interesting question. How does a huge company like Procter Gamble, P&G, navigate the pretty choppy waters of the stock market, especially with all this talk about potential tariff increases?
Right.
Shared a fascinating article from the Motley Fool, and it highlights P&G as a, quote, dividend king. It says they're not just like surviving, but actually crushing the S&P 500 this year in 2025.
Yeah, it's quite a claim.
So our mission today really is to understand what's behind this resilience, what's the secret sauce, and what could it mean for listeners, people looking for maybe some solid ground in their investments.
Absolutely. And this dive into P&G, it gives us a really valuable look at how these, established players with serious scale can handle these big macroeconomic storms. The fact the article calls it a stalwart, that immediately tells you something about how the market sees its stability, like an anchor, maybe, in a pretty volatile sea.
Okay, yeah. Let's drill down on that stalwart idea. The article keeps mentioning P&G's steady performance, even with all the market bouncing around and these persistent tariff tensions.
Right.
It seems like everything else might be, up and down, but P&G's holding remarkably firm. What are the main reasons for that stability?
Well, a huge driver seems to be their long-standing commitment, really, to returning value to shareholders, dividends specifically.
Yeah.
The article hammers this point home. P&G has increased its dividend for, get this, 68 consecutive years.
Wow, 68 years.
Yeah, an incredible track record. That's what earns them that Dividend King title. It signals this deep-rooted priority of providing consistent income.
68 years.
Yeah.
That's more than half a century. It really paints a picture, doesn't it? Financial strength, long-term focus.
Definitely. And their current dividend yield, it's around 2.5%. Now compare that to the S&P 500 average, which is about 1.4%?
Right. Quite a difference.
Yeah, for anyone seeking a reliable income stream from their stocks, that gap can be pretty significant.
Okay, now something else that really jumped out at me in the article was P&G's massive global footprint.
Okay.
They operate in, 70 countries? Sell products in 180?
Something like that.
And more sales actually come from outside the U.S. than inside. So naturally, you'd think that makes them pretty vulnerable to tariffs, currency swings, all that stuff, wouldn't you?
You really would, yeah, just looking at the surface. But what's fascinating is how the article presents P&G as surprisingly tariff-resistant, even with this huge international operation.
Huh. Resistant? How?
Well, their global supply chain is incredibly complex. They've got 24 manufacturing sites here in the U.S., okay, but then 78 internationally.
78? Why?
Almost 4 times as many outside the U.S. And this huge network, instead of being a weakness, actually seems to give them a lot of flexibility, helps them navigate tariffs, other global trade issues.
It's less about, avoiding international stuff altogether and more about being agile enough to manage it, to adapt to these global challenges.
Exactly. It's about adaptability.
What are the key advantages that give them that ability then?
The article points to a really powerful mix of factors, but 2 really stand out. First, their sheer size, just massive. Second, their dominant positions across so many different product categories.
You mean everyday stuff?
Yeah, exactly. Think about the supermarket aisles, right? Beauty, grooming, healthcare, home care, fabric care, baby stuff, feminine care. P&G has leading brands in tons of those essential consumer goods.
Right, I see.
So this broad diversification across brands, different types of products, and different countries means they aren't, overly reliant on just one thing hitting it big or one single market doing well.
That makes total sense. It's like having a diversified portfolio, but all within one company selling things we all recognize.
Pretty much, yeah.
The article also talks a lot about pricing power as being critical. Okay, let's unpack that. What does that actually mean for P&G, and how does it help them handle potential tariffs?
Right, pricing power. Basically, it means P&G can raise the prices on their products without, totally killing consumer demand.
Because the brands are so well known.
Exactly. They're well known, they're trusted, often seen as necessities. So consumers are often willing to swallow small price increases rather than, say, switch to some unknown brand.
So if tariffs push up their costs,
P&G has a better shot at passing those costs on to us, the consumers, through higher prices, instead of just having to eat the cost themselves. Think of it like this. Their brand power is so strong, they can often make us pay the tariff, not them.
And the article actually showed data on this, right? There was that table showing how price increases helped their sales growth over the last few years.
Precisely. Yeah, if you look at that data for fiscal 22, 23, and 24, you see their net sales growth was often driven by higher prices.
Even when other things were going against them.
Right. Even when they faced what the article calls headwinds, like selling less actual stuff, lower volumes, or unfavorable foreign exchange rates where overseas money translates back into fewer dollars, that table really shows their pricing power in action.
It's fascinating how their huge size kind of boosts this pricing power, too. The article mentioned they have a lot of negotiating leverage with suppliers, manufacturers. Can you elaborate on that connection?
Sure. Because P&G buys such enormous quantities of raw materials, plastics, chemicals, paper, pulp, everything, and because they run such huge manufacturing operations.
They're a massive customer.
A massive customer. So they have serious bargaining power with their suppliers. They can often negotiate better prices, better terms, maybe cushion some of the cost increases that smaller companies just can't avoid.
Okay.
And managing those costs effectively just reinforces their ability to manage their own prices. It all works together.
Got it. Now, stepping back from just tariffs for a second, the article also mentioned P&G might do well even if the economy slows down. It calls them recession-resilient. What makes a company like P&G hold up relatively okay during a downturn?
That resilience mostly comes down to their focus on consumer staples.
Staples, like essentials.
Yeah, the kind of products people generally keep buying, even if they're cutting back elsewhere. You know, your toothpaste, laundry detergent, diapers.
Things you can't easily cut out.
Right. People might eat out less, delay buying a new car, maybe skip a vacation, but they usually keep buying soap and toilet paper. That tends to keep demand relatively stable, providing a reliable revenue stream for P&G, even in tough times.
So for someone looking to maybe ride out potential economic storms, P&G could offer some safety there.
That's the idea, yeah. A degree of safety.
And it's not just about weathering storms. P&G also seems pretty committed to rewarding shareholders through what the article calls its capital return program. What does that involve?
So that program covers two main things. One is the consistent dividend hikes we already talked about.
Right, the 68 years.
And the other is stock repurchases, or buybacks. That's when the company uses its cash to buy its own shares back from the market.
And how does that help shareholders?
Well, when a company reduces the number of its shares floating around out there, each remaining share represents a slightly larger slice of the company. So it can potentially make each share more valuable over time, and it can boost earnings per share, or EPS, even if the company's total profit isn't growing super fast.
Okay, so it supports the stock price.
It can, yeah. It's another way they return capital, and that can make the stock attractive beyond just hoping the price itself goes up.
Now, the article did throw in a note of caution, didn't it, about P&G's current valuation. It mentioned a price-to-earnings ratio, PE, of 26.6, which is above its 10-year median of 25.7.
Right.
For listeners who maybe aren't deep into financial metrics, why is that higher valuation something to think about, especially if tariffs do end up hitting future earnings?
Okay, so a higher PE ratio basically means you're paying more today for each dollar of P&G's current earnings compared to what people have paid on average over the last decade.
Like it's more expensive relative to its profits.
Exactly. Think of it as how many years of current earnings it takes for the company to earn back its stock price. Now, P&G has this great track record, sure, but if tariffs or something else were to seriously slow down their profit growth in the future,
then that high price might be harder to justify.
Precisely. That higher valuation might look a bit stretched, and the stock price could, potentially pull back. Investors are paying a bit of a premium right now, partly for that stability and the reliable dividend, but slower growth could make that premium seem less worth it.
So you're maybe not getting as much bang for your buck right now compared to its historical average, even though it's stable.
That's a good way to put it. Yeah.
Okay, so despite all these strengths we've talked about, the resilience, the dividends, the article still kind of frames P&G as maybe a good buy, but for a specific type of investor.
Right.
Those who are more risk-averse, looking for something dependable, long-term, something that can handle trade issues and economic cycles. Why does that still hold true, even with those valuation worries?
Well, for investors whose main goal is stability, maybe predictability, and especially that dependable dividend income, P&G still presents a pretty compelling case.
Over potentially higher growth elsewhere.
Potentially, yeah.
Yeah.
If you prioritize that steady income stream and maybe less day-to-day volatility over chasing potentially higher but also riskier growth stocks, then P&G fits that bill. Their long history suggests they can navigate different kinds of economic weather, including trade tensions, and keep rewarding shareholders. The article even goes so far as to say their dividend is arguably the most reliable among all U.S. public companies.
A rock statement.
It is. So it really comes down to prioritizing consistent, even if maybe not spectacular, returns and wanting potentially lower volatility in your portfolio. And honestly, in a world where savings accounts offer next to nothing, getting a reliable 2.5% yield just for holding the stock, that's quite appealing for a lot of people.
Yeah, I can see that. It's interesting, though, that the article also made sure to say, hey, there might be far better bargains and higher yielding stocks out there.
Right, it offered that balance.
So what's the main takeaway here for someone listening, thinking about their own investments?
I think the crucial thing is really aligning your investment choices with your own financial goals, your timeline, and, importantly, your personal comfort level with risk.
Okay.
P&G offers a specific package, you could say. Stability, reliable dividends, resilience against economic bumps. If that package matches what you're looking for, great, it could be a solid fit.
But if not?
But if your main aim is chasing faster growth, or you need a higher immediate dividend yield, and you're okay with more ups and downs in the market, then yeah, you might find other stocks that are a better match for your specific needs. It's not necessarily a one-size-fits-all situation.
Right. So let's try to wrap this up for our listeners. What are the absolute key things to remember about P&G's performance and its ability to handle potential trade wars based on what we've discussed from this article?
Okay, the big takeaways are, I think, P&G's sheer size, its really diverse portfolio of essential products we all use, and its significant pricing power. Those seem to be strong defenses against tariff pressures. Their incredibly long history of raising dividends offers real stability, and their focus on consumer staples gives them a cushion during economic slowdowns. That's the plus side.
And the caution.
The caution is, be mindful of that current valuation. It's a bit higher than its historical average. And really think carefully about whether P&G's whole investment profile stability, moderate growth, reliable dividend truly aligns with your own individual financial goals and how much risk you're comfortable taking on.
That's a great summary. Really shows how even a company we think we know well can have these complex factors driving its market story. Okay, so for a final thought to leave everyone with, something to maybe chew on, considering P&G's proven ability to pass costs onto consumers, that pricing power, we talked about how might changing consumer behavior affect that. Maybe people getting more willing to try cheaper store brands. Or what about increased competition from newer, maybe more nimble companies popping up in some of their categories?
That's an interesting point.
Could those things eventually chip away at P&G's pricing power and its future performance? Is this tariff resistance we see now a truly sustainable long-term shield? Or are there maybe other big shifts happening in the market that could challenge P&G's dominance down the road?
Yeah, that's a really good question to ponder. Is past performance, even P&G's, always indicative of the future?
Definitely something to keep in mind when you're thinking long-term about this Dividend King. Thanks for taking this deep dive with us today.